So, first 3 quarters of the year, worst first 3 quarters in almost 20 years. So it's not been fun what's going on in the markets. That said, there's lessons to be learned, and these are the times we fall back on fundamentals, we fall back on history, we fall back on what we know about the markets. So I compiled a list of some of my favorite graphs over the past couple weeks, and I share them in today's blog so that you can digest them and learn what I've inferred, and hopefully it keeps you on course and feeling confident about your strategy. And of course, we're here to help. The first graph you'll see, if you read below, is a graph that talks about bull markets and bear markets. Essentially, in the last 76 years, since 1945, you'll see that there's about 64 to 65 years of bull markets, and about 11 years of bear markets. So about 15% of the time, you're going to experience a bear market. Just a fact. The good news is that they last on average, if you go back to 1945, they last on average about 1.1 years. If you go more recently, they're even shorter. Where a bull market lasts about 5.9 years. Big difference. So they'll happen. They're gonna be here. You're gonna see them. You're gonna experience the bear markets, but generally speaking, they're much shorter than bear markets. So next graph talks about recessions and the markets. And what you'll see if you read below again is that the markets turn while you're in a recession, which speaks to one of my key tenets, which is the markets are about 6 months forward looking. It's, I think, a really key statistic and thing to focus on, because generally speaking, markets turn before you think they should. You're here saying, oh, unemployment is high, or inflation is high, or we don't know what's happening with this pandemic or that pandemic. The reality is that, yeah, it may feel ugly. It may not feel pleasant. The markets don't care. They're forward looking, which makes, of course, timing the markets virtually impossible. The next talks about the 20 best and 20 worst trading days since 1980. What you'll see is that most of them happen within a relatively short period. So you have negative days and positive days. The best of them over the past 20 years happen within a few months of each other. Additionally, 9 of the worst trading days over the past year happen in positive years, and 11 of the best trading days happen in negative years. So you think we can outsmart the markets, or you want to get too cute with it, just know there's a likelihood that you're going to miss some of the best days, and that is not healthy for long-term performance of the markets and your portfolio. So next chart I focused on really hits the timing conversation head on. And it talks about a fully invested portfolio since 2018 to now versus one where you got out of the market for a little bit, where you got out of the market trying to time it, and it shows 3 or 4 different end results. By far the best end result is staying invested. So again, speaks to you can't time it. It's a fool's errand, and the next chart really gets into what your dollar amount would have been given a couple different circumstances. My next chart I hit on, which is one I love, because today we have President Biden, Democrat, in office. A couple years ago we had President Trump, Republican, in office. And I have the envious position of meeting with clients that are both Republican and Democrat. And guess what's happening now? The Republican clients are swearing it's all Biden's fault, and Democrats are terrible for the markets. And where Trump is in, same thing happens with my Democrat clients. The truth is, yeah, there is some impact that they have on the economy. There is some impact they have on policy, but the markets don't care. The markets are up and down, both in regardless of who is in office and the affiliation. And some of the best times have been during Democrats and some of the worst times have been during Republicans, and vice versa. So to get too caught up or try to say I'm going to be more cautious now that this party is in, or allow the party who is in power dictate your investing philosophy, is a very, very ill-advised strategy and would have one where you missed a lot of good years, regardless of your political affiliation. Couple more charts for you. One, I talk about the fact that markets are, despite whether they're up or down, every year just about, you have major downturns. Years where the markets are up 20, 30%, at one point the markets are down 19%. And so it goes basically every year since 1980 to present day, talking about here's where the market is, and here's where it was at its worst. So I think that's something you should take into consideration and really use as a tool to learn. Next, and my final chart, is a famous chart, comes out each year and shows the last 20 years returns. The average investor over the last 20 years did 3.6% rate of return. A boring old 60-40 portfolio, 7.4% rate of return. Investors make bad decisions when it comes to their portfolios. They sell at the wrong times, they get in and out at the wrong times, and it's something you want to desperately avoid. So investments work, investors don't. Leave investments on this, leave emotions on the side, and know we're here to guide you. Hopefully this is eye-opening. Definitely read the charts because there's some really good ones that you can feel free to share with others. As always, I'm Andrew Rosen, President of Diversified. Stay wealthy, stay healthy, and stay happy. Bye.